Scott Chronert, Citigroup U.S. equity strategist, and Julian Emanuel, Evercore ISI senior managing director, both join us here at Post 9. Scott's bull case for the S&P year-end 2025 is 6,900. Julian sees the S&P hitting 6,600 by mid-year 2025. Good morning to both of you. So you both expect another good year, even though, did anyone expect a year like this?
I know we certainly didn't expect it going in, but I think the assumption was that we'd get follow-through on the earnings broadening thesis, which kind of played out. But what really surprised everybody was the valuation backdrop, where if you would have told me a year ago at this time that we were going to end the year 24 times trailing, we might have looked quizzically at each other. And I think that's really been the big surprise in terms of how aggressively the market's pricing in a lot of bullish expectations about the longer-term outlook.
So what does that mean, Julian, for the setup for next year?
Well, if you think about it, right, you've come off of what's going to be 2 years of plus 20% or more. The third year tends to be positive. It tends to be volatile. And if you think about the policy setup, the incoming Trump administration, we think that the first year of the second term is going to look a lot like the second year of the first term. Volatility, higher stocks, driven by tax policy, driven by immigration, driven by, literally all the concepts of starting new in terms of government and policy. But again...
But you don't worry about we were talking about immigration and tariffs and potential negative impacts of those policies.
Well, you do worry about it. That's part of the unknown, that when you think about the market, it increases the probability of both positive and negative outcomes. And so for us, we step away from all of that and get back to the fact that when you think about what ends bull markets, it's not valuation alone. We are expensive, no question about that. But what ends bull markets is an oncoming recession or so much exuberance, think 2000, that things get carried away. We don't see either of those at all at the present time.
What do you think lifts recession odds somewhere in 25? Because we went around the block on it this year, too.
Yeah. Well, I think the market's still pricing in 25% of recession probability. Our economists are still of the view that there's a labor unwind that we need to be wary of going into the first start of the year. I don't see it. I think we're in a no-cycle circumstance. We're still migrating our way out of the post-pandemic time frame. To your earlier discussion, what's really happening here, recession or not, or recession risk or not, is that the underlying fundamentals for the S&P 500 are in really good shape, okay? It's really interesting. You go back to look at it, sales per employee has really been aggressively improving, even though headcount for the S&P 5 has been flattish, right? So all told, what we think we've got here is a really, really constructive fundamental tailwind for the bulk of the S&P, somewhat considering economic risk still out there.
Well,
Julian, you're not terming this, obviously, similar to 2000 or the late 90s, I guess, in terms of the level of valuation. But there have got to be parts of the market that you do find, I would assume, I don't want to put words in your mouth, somewhat scary when it comes to 50 times revenues, for example.
There are, and there's no getting around that in the universe of traded stocks in the U.S. But again, when you think about it more broadly, and you think about the technological developments of the last several years, and you put it against the backdrop of a Fed that, the market has gotten used to the fact that actually there's perhaps going to be fewer cuts next year than expected, but they're still cutting. The liquidity backdrop, you will be scared of those stocks. But again, there are stocks whose fundamental stories will grow into some of those valuations, maybe not at 50 times revenue.
But Scott,